Hey, Merryn Talks Money listeners, we are back with new episodes and a new format. We heard from a few of you over the summer suggesting that we break out the chat between me and John from our weekly interview, so we thought we'd give it a go. That means that this week you'll get the usual thought-provoking interview with our guest on Friday, but also a chat on the weekly news with John on Thursday, looking at everything he's been writing about and I've been thinking about over the week. And we're bringing you bonus episodes this season, which will hit your feeds on Tuesday from next week. Look out for Merryn Talks Your Money. John and I will address listener-submitted questions on personal finance. Hope you enjoy, and as always, keep us honest by submitting questions and comments to our show email at merrynmoney@bloomberg.net or via Twitter or X.
Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money Weekly Roundup. This is our thoughts on the biggest stories in markets and economics this week. I'm Merryn Somerset Webb, senior opinion columnist.
And I'm John Stepek, senior reporter and author of the Money Distilled newsletter.
You see how much change there is here? Normally I introduce you. Now we have this new system where you introduce yourself. How does it feel?
It feels quite intimidating.
Everything's intimidating at the moment, isn't it?
Yes, not least the bond market, which is one of the topics we will get onto in this week's show.
We will come on to the bond market shortly. So we're doing something different here today. What we're going to do is we're actually going to talk about proper topics rather than just rambling around in circles like we often do. We're going to talk about the things that you've been writing about in your Money Distilled newsletter, which is excellent, by the way. Everyone should be subscribed to that. If you're not, do it right now. Even take a break from this podcast, put it on pause, sign up to Money Distilled, and then come back. That's fine too. We're going to talk about gold. It's having a bit of a moment. We're going to talk about why. But of course, I'm a proper gold bug. I love gold. I always have gold in my portfolio. John is a little more cautious about it. He's more, sometimes gold, sometimes not gold. I'm always gold. We'll talk about that. We'll talk a bit about the UK, which is really doing fine despite what the government says. And then we'll talk a little bit about this most recent market wobble and the many market wobbles that we've seen in the past and we'll see in the future. So let's start, John, with gold, which, as I say, you tend to be more rational about than me. Maybe I'm just a genuine old-fashioned gold bug, and I'm always worried about fiat currency, always worried about debt, always worried about everything collapsing. But at the moment, gold is behaving as though I'm right?
Yeah, absolutely. And I mean, to be fair, I'm quite a fan of gold. I think there's good reasons to own it. But yeah, gold's been going up, and it's obviously hit a record this year in pretty much any currency that you care to name. And the weird thing, or the thing that has been throwing people to an extent, is that up until very recently, gold has kind of moved with US real interest rates. So if interest rates are going up, then gold should be going down. And if the dollar's fairly strong, then gold should probably be going down. But that hasn't actually been happening. And certainly to my mind, the most obvious reason for that is because of the nature of the people who've been buying it during this gold bull market. And so normal people and investors who normally buy via exchange-traded funds, ETFs, those holdings have been falling consistently up until very recently. And the people who've been buying are actually the central banks. And central banks like across the world, but obviously the big ones are China and Russia. And those central banks are the ones who are worried that they might at some point not be able to rely on what is currently the dominant form of money in the world, which is the US dollar. And to my mind, that's what has been the main driver of this gold bull market. And that's really interesting because it is somewhat different to what has driven it up until now, or in the past at least.
It's interesting, isn't it? We talked about this in one of the podcasts that we did from the Edinburgh Fringe with our panel guest. We talked about what it is that's driving gold and why central banks want to keep holding it. And it did come down to the sense of geopolitical insecurity, effectively.
Yeah, and well, I suppose the other thing I do find interesting about gold, and I mentioned this in the newsletter, is there's a very famous moment in Gordon Brown, one of his many things he did that lots of people don't like, where he sold the Bank of England's gold in 1999, he started. And that also happened to be basically the all-time low for the gold price. So he often gets criticised for that, and that's perfectly reasonable. It's an acceptable stick to kind of beat him with. But when you look at why he did it, I think it's actually represents a really interesting turning point, or the kind of bottom for gold. Because what he did was he sold the gold reserves and then bought euros with the money.
So there's a vote of confidence in this new currency, and also a vote of confidence in what he believed to be a new world.
Yeah, absolutely.
A globalized world, a world in which you didn't need old-fashioned muck like gold because it's very peaceful, everyone's happy, globalization is expanding at pace, and it makes sense to hold the new currency of your neighbor.
Yep, and now we're going in the opposite direction again. Gold's at a kind of record high because that new world has demonstrably, it's not necessarily failed, but it hasn't it hasn't gone as smoothly as was hoped back then. And I do think that's probably the key difference, because it's not even so much about inflation or whether it'll hold its value. It's actually about whether you're going to need to have a form of money that is not dependent on another country's permission or creditworthiness to use it. And that is I think that's quite radical. That's quite a big shift.
It is, and it's what they always say about what the gold bugs always say about gold, that it's not dependent on anything, doesn't rely on any government, doesn't rely on any politics, doesn't rely on anything. It stands alone as a currency and an asset.
Yeah, and to me that implies that probably the bull market can go further. But I also think is the one other thing I would say that's also important is that this is about gold. It's not about all the offshoots of gold. I mean, I think if gold keeps going up, then I think things like silver and gold miners will do well. And if it gets bubbly, which I don't think it is yet, but it's presumably at some point it will get bubbly, then you would expect silver and gold miners to maybe start outperforming it. But at the moment, it's very much about this fundamental case of I want to own an asset I guess the US government can't confiscate from me by the back door.
Yeah. I mean, it's interesting, isn't it? And we've been saying for years to everyone who says gold is over, there's no point in gold, Bitcoin, et cetera, all the other reasons not to have gold, that if it's good enough for the world's central banks, and they all have some gold, and the majority of them are increasing their holdings of gold. I don't think there are any central banks left selling gold. If it's good enough that every global central bank wants to hold it as a financial backup, why would you not do so too?
Yeah, exactly.
You don't seem to need to make much more of a case than that, do you?
No. There's nothing superstitious about it. This is as close to the science of monetary policy as it gets.
Yeah. And you can argue about whether, Bitcoin is a new form of digital gold and you should hold that for the same reasons, but the world's central banks aren't doing that. They're holding gold.
At least they're not telling us.
That's true. There might be something else going on. Now, back to the UK to talk about that now. The UK Central Bank is not one of the big gold buyers at the moment, as far as I know.
Not that I'm aware of. I need to double check the most recent stats.
Maybe there should be. Looking at the UK, we heard terrible things from our new government about the worst financial inheritance ever. Everything is terrible. You've got to let old people get cold over the winter to stop the bond market imploding, et cetera, et cetera. But you and I, we don't really buy that. In fact, this inheritance wasn't that bad. I mean, it's bad in lots of ways. Terrible productivity, awful levels of debt, and out of control public sector, et cetera. But it's not quite as bad as our new government would like to have us think.
No, I mean, I think the main point is that the UK economy is going in the right direction. And as you say, there's lots of things you can criticise about it, and there are lots of fundamental problems that need fixing.
Oh, huge fundamental problems. I mean, I'm giving you this, things aren't quite as bad as we think they are, but if you pull right back away from the minor stuff, like, a little bit of growth here, a little less inflation there, et cetera, as a whole, it's pretty bad. But let's do the positive bit first.
Well, definitely. I mean, I suppose the point is, earlier this week, we got one of the Labour MPs, I think it was Lucy Powell, was put on the spot, obviously, about this thing of getting rid of the winter fuel allowance. And she sort of came out and said, oh, well, if we hadn't done it, then there'd have been a run on the pound, and, we'd have basically had a repeat of the gilts crash in 2022. Now, I'm going to park the fact that I always end up explaining why the gilts crash actually happened. So I'm sure you've all heard that before.
Yeah, please go back to past episodes and listen to that. John explains it very well.
Exactly. Regardless of your views on that one, the difference that 1.4 billion in a government spend of more than $1 trillion is not going to tilt the gilts market over into kind of, throwing up again, basically. So this is kind of patently nonsense. But it is a very useful excuse for whatever the government decides that it actually wants to do at the next budget. They can basically state whatever policy they want and then say, this is all because we need to worry about the bond market, even if the net effect of the policy will probably be to raise less money. Like with the non-doms, for example, there's risks there that they might just drive them all away rather than milking them for a bit more cash.
Well, it's interesting, isn't it? I mean, they'll stay as long as the UK is a nice place to live, or a lot of them will stay as long as the UK is a nice place to live, as long as they feel, safe in the UK, as long as they can educate their children well in the UK and the private healthcare system stays strong and all that kind of thing. I think a lot of the non-doms will stay. But that's another podcast. We'll come back to that. Is the UK a pleasant environment to live in?
It's all pretty straightforward stuff. It's like the economic data keeps coming out like pretty positively. The consumer spending's healthy enough. Companies keep coming out with data saying that actually everything's fine. It's like earlier this year, Ryanair was saying that it wasn't sure how summer was going to be, but as it turns out, both Ryanair and Wizz Air had record Augusts for traffic numbers. The market for luxury watches is even stabilising. House prices, annoyingly, are starting to tick back up again. The FTSE 100 is being pawed over. You get Rupert Murdoch's kind of like equivalent of Rightmove in Australia is thinking of buying Rightmove here. We've also just had a couple of big consolidations in the real estate investment trust market. Everything's improving. And the interesting thing is Britain does seem to be divergent from certainly the Eurozone and possibly even the US on this front. It's like there are signs of the economy getting stronger at a time when, the Eurozone activity surveys have been surprising to the downside, but here they keep surprising to the upside. America, I think most people are starting to think that America is now at risk of finally seeing a recession or a slowdown. That's just not really the case here. So I think it's very hard to make the case for the level of sheer misery that comes out of the mouths of, Keir Starmer or Rachel Reeves every time they're talking about the UK.
Yeah, well, I'll give you all that, but I would still say that if we look at it from a wider level, if we look from a higher level, there's so much wrong here. There's so much wrong. And when we're looking at an economy where we say, oh, this was great, some bank or the other has had an upgraded UK growth from 0.8% to just over 1%. Woohoo. I mean, this is awful. It's awful. And saying we're doing mildly better than the Eurozone, I mean, how much lower could a bar get? You're still looking at somewhere with massive debt, with a public sector that's absolutely out of control, with a tax system that is beyond hideous and about to get worse, where, making money is constantly punished. We were talking the other day when we were talking about, this is something we haven't released yet, but we were talking about student loans, etc., and about how much tax young people end up paying. And I was thinking about it again, if you're young in the UK, to pay for this massive public sector and for the priorities of a small group of politicians, you enter work, you pay 20% in income tax, 8% in national insurance, 9% in student loans, 3% in pension. What have you got left? You're lucky enough to make it to be earning just over £50,000. You pay a marginal rate of 40% in tax, plus 2% in national insurance, 3% in pension, 9% in student loans. You're paying over half of your money away. What are you getting? What are you getting? How do people coming into the labour market in the UK, when they see their paychecks and they see what they get for that, I look at it and I think, well, I take your point that things are not as bad as our new government tells us that they are. Of course, they're not that bad, but they're not very good either. And I can't see any sense of that bit getting better. How do you grow an economy when you take your young people, put them into work, and then remove almost all of their income immediately?
you're kind of nailing the same problem in a way. So it's an issue of structural stuff. And to my mind, the fact that the economy is actually now on a recovery trail should mean that a government with the right policies would have the time to start addressing some of these issues. And instead, what we're going to get is a government with more of all of the wrong policies, probably, judging by the way they've talked so far, basically expanding the public sector, I would expect, punishing wealth production more.
And expanding the reach of the public sector. I mean, I've seen you on Twitter getting really irritated about Oasis, John. I'm sorry about this for you, but, you said quite rightly, this is none of the government's business, but out. There is so much that a new government should be focusing on. I mean, the fundamentals here are terrible. And then, you turn around and start trying to get involved in the price of concert tickets. Enough already. Focus on the big stuff.
Well, the frustrating thing as well is that we've just come out of 14 years, or call it, actually call it 14 is a bit much, but call it 8 years, because of the post-Brexit government being different. But 8 years of ostensibly the most right-wing UK government ever. And all of this crap happened on their watch, and it's just getting accelerated by the new guys. The problem is there is nobody who stands for the sorts of policies that would improve things structurally. And it feels as if we need to get to some sort of rock bottom, possibly akin to the end of the 1970s, and Margaret Thatcher coming in, where we get somebody who actually does decide we can't go on in this particular direction, and the country decides that we can't go on in this particular direction. You can see the frustration. I mean, that Oasis tweet is slightly depressingly, I think, my most popular tweet ever. And there's clearly a lot of people who agree that why on earth is the Prime Minister even given a minute's thought to this? But we've got a while to go before we get to change horses again.
John, do you see what I did there? Do you see how I managed to move you from being a little bit optimistic to quite angry and pessimistic?
Yeah, it doesn't take much.
In 4.5 minutes.
I'm easily triggered, Merryn.
You so are. I'm going to use this more. We might do a bonus podcast called Triggering John, where I just say the words that I know really upset you and see what happens. Speaking of being easily triggered, stock market.
Yes. No, the stock market. Well, we had another wee kind of market panic crash, whatever you want to call it. Mainly due to Nvidia. That's how you say it, Nvidia.
Oh, I say Nvidia. I say okay.
Yeah, so did I.
Have I been saying it wrong recently? All this time? All the way through one of the greatest bubbles of all time, I've been saying it wrong.
Exactly. Shows you how much we know about tech.
Except for that it's too expensive.
Yes, exactly. And that's all that matters.
But actually, it is.
Yeah, well, yeah, as it turns out. So, Nvidia, in a single trading day, Nvidia fell by 10%. And when you actually look at a chart of the Philadelphia Semiconductor Index, which is basically all the chip stocks in the US, about 30 of them, the 30 biggest ones, it's actually now down about 20% from its peak, which came a couple of months ago. And I think it's increasingly fair to surmise that the AI bubble has popped, and it's probably a jittery road down here from now, the way that the dot-com bubble popped.
Yeah, I mean, it's important to remind people that bubbles pop more slowly than you think. It doesn't have, you don't come off 40% in a day. It's a little more slow than you think. So I think you're probably right that bubble has ended. But we'll see. I mean, we're often wrong on this stuff, right? But the important thing to remember is that a mini bubble and a mini fall or a mini collapse, even quite a big collapse, is not necessarily something that you should be selling into. And I just want to give you a couple of points from the latest Schroders equity lens from our nice friend Duncan Lamont, who points out that you get 10% falls quite often. They happen more years than not, and it's not unusual to see a 20% fall once in every 4 years or so. He's got a lovely chart on that. And he then has another fascinating table that is very well worth looking at, that it shows you how if you give up on the stock market after a big fall, I mean, if you get out before the big fall, well done you, fantastic. But if you try and get out as it falls or after it has fallen, it can often be a horrible, horrible mistake. So He's got a chart that shows what happens if there's a nasty crash, and then you either stick with stocks or you dash for cash and then go back in later. And all the way through, if you stick with stocks, the number of years to get your losses back if you sell out, it's never much more than a couple of years, except for in 1929 when it was 15 years, very bad. But if you dash for cash, it can often go up into the 6, 7, 8, 9, 10 years, 34 years after 1929, by the way. And if you had sold out in 2008, you would still be underwater if you'd stayed in cash. So, in the end, it's usually better to stay in than to get out. Unless, of course, you're very good at timing your ins and outs.
It's interesting, isn't it? I mean, I think those stats are always really fascinating.
And reassuring.
And more than anything else, they kind of make the case for, look, just have an idea of what you want to own and put some money in it every month. And then you're not buying at the top and you're not selling at the bottom. You're just, because that's what life is for most of us. Most of us don't stick a lump sum in when we're 20 and then try and manage it for the rest of our lives. I think that the regular rebalancing once a year, it really does make the case for that sort of slow, sensible investment style. And if you want to have fun with Bitcoin, you can do that, on the side.
You still don't own any Bitcoin, do you, John?
No, sadly not.
Hate mail. Send it in. Thanks for listening to this week's Merryn Talks Money and our thoughts on what's been happening over the last week or so. If you like our show, rate, review and subscribe wherever you listen to podcasts. Also be sure to follow me and John on X or Twitter at MerrynSW for me and at John_Stepek for John. This episode was produced by Sam Asadi, production support and sound design by Moses Andam. Question and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net.